I had a student asking me to go over this question here, question 4.27. Now, the main concern is if we scroll down to the answers here, which is what the textbook answers have, it looks a little bit different to this worksheet that we'll be using. Now, you'll get very familiar with this worksheet. We do need to understand how to use it because this is what assessment 2 is based on. So we really need to get familiar. So that's why I really wanted to jump in and do a quick video instead of just giving a wordy reply and not really making sense here. So what we have is we have a question up here, and there is a bit of knowledge that you need in order to do that. What I might do is post some other information, but I will try and talk through it as I speak. But let's jump in. For the people that don't have accounting experience, I'm going to do my absolute best to break it down and hopefully it makes sense. So here we go. It's asking us to prepare a worksheet. So this is our worksheet here we're going to prepare. It says the closing statement of financial position items are given below from Jason Woodstock in the accounting equation format as at 30th June 2021. Transactions for the month of July are also given. Okay, so we've got these here. These are our starting balances. So we call them our opening balances. So if we have a look at our worksheet, we've got a word here called opening balances. So that's very important to note. So we'll have to input that and I'll tell you how to do that. And then here it goes, transaction for July 2021. So we know that these are opening because it's saying it's the end of June, which is the start of July. So our transactions are in July, and after we input all those transactions in here, we're going to have a closing account. So a closing balance of each account. So basically, kind of imagine that you've got lots of different accounts, almost like your personal bank accounts, for every single type of asset or liability or equity here. And we've got our opening balance, so what we have at the start, all the transactions, the plus and minuses, and what we have at the end here in that closing balance there. So what we need to do is build this. Now you'll note that we've got assets up the top, liabilities here, and then something called equity down here. Okay. And what we can do is we can build our worksheet off it. Now, this is what will be given literally exactly as you see it in the assessment 2. So this is why we want to, week 2, get you straight into this. You'll notice in assets, we've got something called current assets and then non-current assets, and you'll also see the same in liabilities where you've got current and non-current liabilities. So what does that mean? So what we do is we've got assets and liabilities, and they all have a lifespan for it. So say an asset might be a car, and a car has a life. So it's got, it might last 5 years and then die. And then liabilities, we could have debt. So that would be like a home loan, something we have to repay, and usually that's got a life of 30 years. So what differentiates current versus non-current? So current is a lifespan of under 12 months, whereas non-current liabilities is something that is greater than 12 months life. So if we have a think of current assets, what's something that we would use within 12 months? So let's say we are manufacturing clothing and we've got all this inventory of fabric. The rate in which we produce stuff, we'll be using that inventory pretty quickly. So that's under 12 months. So we'd call that inventory a current asset. But our machinery, to maybe our sewing machines to sew those, they're going to last longer than a year. So we call them our non-current. If we have a think of our liability, so that is things we need to pay. So think of a credit card. A credit card we have to pay, really, we should be paying by the end of the month. Whereas our home loans, so businesses can have loans too, that is something that has a longer term life, okay? And then we have here, so our beautiful accounting equation, you can see down the bottom, assets equal liabilities plus equity. So they have to match, each sides have to equal. So this is how we know that we've done our worksheet correct. And you'll see how I do it at the end of this. And we've got our equity section over here. So this is basically like the value of our company. So what we normally have here is we would have all the time, you'll always see something called capital and something called retained earnings. So what retained earnings means is if we have a profit from the previous year, we're going to roll that in. As long as the director's not taking that profit out of the company, then those retained earnings are going to roll on because that's a positive in the company. So what I'm going to do this, and I'm going to just wrap my text here. So if anyone does choose to become an accountant, or in finance, you'll become very, very familiar with Excel. Right now I'm using Mac. What is this called? Numbers, I think, and it's, not as good as Microsoft Excel. Okay, so this is what we're doing. So we've got a bunch of transactions and they're obviously financial transactions and we need to figure out what happens with them. But first, as I said when I was reading this, we want to input our opening balances. So we've got something called cash at bank. Now cash is literally cash we have in the bank and we class that as a current asset. Actually, I'm going to put my account names up the top here where it says account. Cash at bank. I might fix this up here. Okay, and it has an opening balance we can see of 39,400. Okay, and look, you can see that this has already got a sum formula in it. So it's summing up all the entries in here. So thank you, that makes life so much easier. Now let's bring this down here. Accounts receivable. So accounts receivable is something that we're going to receive in the future from the sale of goods or services. So if I am selling my clothes and I'm a wholesaler, I'm selling it to say Maya, and Maya comes in and says, I want to buy 10,000 dresses, and I'll be like, here you go, we'll put it on credit, which is accounts receivable, and you can pay me back within a 30-day period term. So usually there's always the 30-day period term, so it's always classed as accounts as current assets, sorry. That's a good little one to remember. I might zoom this in, hopefully, yeah, I hope that makes it a bit easier. And our balance there is a 2,800. Okay, it doesn't, all our assets, it's not saying anything about non-current assets just yet. Then we've got liabilities, so it's basically the reverse. Accounts payable is the reverse of accounts receivable. So again, if I'm a manufacturer and I need my fabric from somewhere, maybe I'm buying my stock from China or somewhere else, most fabric these days are coming from China, then I'm going to probably, instead of paying them cash straight away for the transaction, I might pay them on that 30-day credit. So it's something that I, as the company, I have to pay. Whereas when I'm selling those dresses to Maya, it is something that Maya is taking from me, so they owe it. So Maya owes me money, and then I owe the manufacturer of the fabric money. Okay, so that is a liability because it's something I owe, and that is 1,200. And then down the end here, we've got our capital of 41,000. So that could be something like, if we start up a business and a director injects some funds into it, we would put that. So let's say the director injected 41K of funds into a business, and that's its positive in the equity section. Okay. Okay, let's go into the juicy stuff. So what we have here is our transactions. Now, there is some information I'm going to post about accounts receivable and accounts payable, so it will be a good idea to watch, have a read of that. So what we do in this column here is we write our date. So we've got we can go to July, or you can just write 2. It just makes, when it comes to marking, a lot easier for me to know what you're actually doing. Okay, so first one, number 2, receive 2,800 from accounts receivable. So what it means is when it's saying received money from accounts receivable, it means I've got money coming into the bank. But the accounts receivable that owe me 2,800 are now paying that. So what we want to do is we want to increase the money in our bank because we've got money coming in the door. So I always like to use the term money coming in the door or going out the door. Now, what you'll learn with these worksheets is there's always at least a double transaction. So what happens on one side, so again, I'll post another thing because this is quite a lot of content I'm trying to explain within a video. But what I'm going to just write some words up here. So you'll see these debit, DR, and credit over here in liabilities and in equity. Look, I'll explain that in writing. I don't want to overwhelm you in a video, but basically you'll always see that a transaction equals itself. So you can see here, cash at bank, money coming in the door, and where is that money coming from? It's coming from our accounts receivable. So it's saying that balance, what we need to do is we need to reduce that balance because they paid it. Maya paid us $2,800. Okay, so what you can see is these two negate each other. We've got money coming in and we've got money coming out. So there's always two sides of the story that always equal. Okay. Let's go to the next one. 3 July, paid $1,000 of accounts payable. So again, it's saying we've paid money. So that is money going out the door, okay? Be very clear when you read it. So money going out the door, we've got cash at bank, and we want to reduce the balance because literally think about it. If I'm paying a bill, literally I'm taking $1,000 out of my account. There's $1,000. And then we've got this accounts payable here. So right now we owe $1,200 and we are paying off $1,000. So we need to reduce the balance by $1,000. So it says if we scroll down to our balance, let me show you, we only owe $200. Okay. And you can see with the accounts receivable here, that's cleared it out. So that means Maya doesn't owe us anything anymore. I promise you, this probably sounds overwhelming now, but the more you do it, the more you'll get the hang of it. I promise. Okay, next one here. Paid rent for July of $700. So again, we're paying something, it's money going out the bank. $700. Okay, now, this is another piece of information here. So this retained earnings thing, this is, I'm going to make a note here, retained earnings, RE, is basically your profit and loss statement. Okay, so what does our profit and loss make up of? It makes up of revenue, and it makes up, well, if I go profit equals, or it can be a loss, profit loss equals revenue minus expenses. So what is revenue? Money we earn from selling stuff. What are expenses? The cost of those selling things. So for example, here we're paying rent. Rent isn't an asset, it's not a liability, and it's definitely not equity. It's an expense, it's a bill we have to pay. So for this worksheet purpose, we are sticking any here. I'm going to make it here. So this is any revenue or expenses here. Now, revenues will always be a positive figure in this section, and expenses will always be a negative figure in this section because we want to reduce the balance with an expense. So if we pop that in, we've got 700 here. Let's make sure we've got it in the correct row, and it's an expense, so we are reducing that 700. So I just explained that retained earnings is basically our P&L, and you probably have heard the term of a balance sheet. So this worksheet here that we see is basically a balance sheet. So here, assets equals liabilities plus owner's equity. This is our balance sheet. So in the next coming weeks, you'll see it, but this is really just starting to form how we can then create a balance sheet here out of all this information. And out of this information here, we can actually create a profit and loss statement. So I'll do that later on. I'm not going to overwhelm you now, but just have that in the back of your head that this worksheet actually creates our balance sheet and our profit and loss statement. All right, 5th of July, what have we got? Send invoice to customer of $5,600. So customer, that means someone's going to pay it to us. So that's accounts receivable. And what we're doing is we're increasing the amount that they owe us, so that's a good thing for us. It's an asset, so 5,600. And then what's the other side? So we're not receiving any money yet, but what we are is we're selling something. So we're booking revenue. So we go all the way over here and go 5,600. So on the other side of that transaction, if it then says, which do we have that transaction yet? Not yet. If we do that later and it says that that customer then pays us the money, what do? We do 5,600 here because it's money coming in the door, and then we go negative 5,600. Oh, one too many zeros. So what you can see is that then crosses out our accounts receivable, and all we've got really left showing is our revenue coming in and the cash at bank coming in. So that means we've earned some money in our revenue and we've received the cash for it, okay? But we haven't done this transaction yet. Okay, 5th of July, let's go the 7th of July now. What have we got? Purchased office equipment for cash of $2,000. Office equipment. So that's an asset. It could be potentially current. It could be non-current. But I'm going to presume maybe it's something like furniture or computers, and I'm going to call it an asset. It's not an expense because it's something, let's say the laptop that I'm using right now. So I'm going to call it a non-current asset because it's got a life greater than 12 months. Okay, so what is it? I'm purchasing something, so that's money going out the door because it's costing me money. That's $2,000 going out. And then I've got a non-current asset now coming in the door. So I've just picked up my laptop for $2,000, and that's a positive there. Okay. Okay. 9th of July. Recorded cash sales of $800. Okay. Cash sales, money coming in the door, and it's cash, so it's happening straight away. We've recorded some sales that, yay, that's revenue, and yay, that's cash coming in the bank. That's a pretty easy one. Okay, recorded credit sales of $1,500. So 10 July, recorded sales of $1,500. So that sounds very much like this 5,600 here, because what it's saying here, if we bring it here, recorded credit sales, so there's no cash involved yet because we're just recording it. Credit sales, so that means sales made on credit, so we're making a sale, so let's jump over into our revenue and record that. So yay, that's a good thing. And then it's on credit, which is accounts receivable, so we want to increase our balance by 1,500 there. So it's very much like this 5th of July one here, exactly the same. All right, 14. All right, now this office supplies. Purchase office supplies for cash of $330. So we're purchasing something, that's money going out the door. Let's go negative $330. Now office supplies. Now it sounds very much like office equipment, but it is an expense. Office supplies are like pens and paper and things you consume. Okay, so it doesn't really have a life. If I buy a pen, it's not worth anything the next day, really. I mean, someone might buy it for 5 cents, but in terms of a business, it's worth nothing. So we call that an expense. When we buy something and it's not worth really anything, it's an expense, okay? It's the cost of doing business. So remember, expenses are negative over here. We go 330 in our retained earnings, okay? Cash sales of $2,000, sorry, 23 July. Yay, that is money coming in the bank, and it says it's cash. Okay. So you'll see some of these transactions kind of repeat themselves. So cash sales, that is revenue, and it says it's cash, so cash at the bank. Okay, and then drawings by Jason Woodstock of $800. Now, whenever we see drawings, that usually means a director. If we look, it's called Jason Woodstock in accounting. So, you know, he's the owner of the business. So what we need to do is capital. So this is something that students often get incorrect. They get capital and retained earnings mixed up. So again, as I said, retained earnings is our P&L, and our capital, as I explained at the beginning, say for example, the director Jason decided to inject $41,000 into the business to start it up. But now on the 31st of July, he wants to take $800 out of the business. So because he's taking it out, he's reducing his capital by $800. But as he's taking cash out, what does that do? That reduces it by $800. Okay? So there are all our questions done. It's saying prepare the business transactions. So if we go down, we can have a look and see if Liana did it correctly, if I made any mistakes. So you can see here, I just want to highlight that they're not saying what's current and what's not current. So we really want you using this worksheet because, as I said, it is assessed in this worksheet format. So I just realized that the whole question doesn't have the answers doesn't have the whole question, so that stumped me for a second. So here it cuts off at 3:30, 14th of July transaction. So we have our, these two haven't been shown in the answers, but this is obviously how you answer it there. So lucky I've done this video. Now, what we do then now is, this is all complete. I've done it correctly because I've checked with the answers and I also know what I'm doing, done this a couple of times. And then another way we can check it is, remember our accounting equation. We've got assets equals liabilities plus owner's equity. So assets of $49,270 should equal the sum of these two. So if we add them up, they do. So we know we've reconciled it and we know we're correct. So that is done there. Now it does have a part B to it. So if we go here, let's bring up our worksheet. At the end of July, Jason realized that the customer invoice sent on the 5th of July was recorded incorrectly. The correct amount should be $6,500. Explain what type of error Jason made and explain the impact of this error on the statement of the financial position of the statement of profit and loss. I'm not sure in terms of what type of error, if there's specific classing, but what he has done is he's under-recorded it by the value. What you probably would do is you would reverse this transaction and re-record it at the correct amount. So I would probably, if we could go insert, then I'd just do a negative 5,000. So let's just say, let's have a go at this here. Negative 5,600. So we basically do the very opposite to reverse it out. So that is negative 5,600. So we reverse it out. So you can see here, positive, negative, it reverses. And then what we do is we do our correct transaction, which is 6,500. And over here, 6,500. So that fixes it up. If we didn't fix it, what impact would it have? So it's asking us what's the impact on the statement of financial position, which is our balance sheet. So many terminologies, but you'll get used to it, I promise. It wouldn't really have too much impact because it would all equal. It would just mean that it's incorrectly recorded our accounts receivable and then also our retained earnings. Now, how would it mean? What would it show on our retained earnings if we didn't do this adjustment? Basically, we're under recording revenue by, 400 minus that, it's $900 we have a reduction in the revenue recorded, okay? But that's a bit more theory side of it. In the assessment 2 worksheet, you probably won't have to do that. Maybe potentially on the quizzes, there might be some theory questions, but that is, so I'll leave that up if you want to screenshot and look at the answers in your own time, but that is how we do it. The transactions itself won't get too much more challenging, but we will be building on this in order to how to then create a profit and loss out of this information. So, and then how do we then prepare a balance sheet out of this information I've highlighted below. But I don't want to get into that too much now because that is going to be an information overload. I think what's really important to understand is our current versus non-current. Our accounts receivable is important. Our accounts payable is important. Distinguishing capital and retained earnings is important because students generally get very confused with that section. Again, accounts payable, accounts receivable, I might post something on that explaining it. They're what really trick students up. And what's also important is, remember how I said there's two sides of every story. So you'll see here we've got two 800s, and up here we've got two 2000s. Sometimes you might see something where, you know, let's say we made a sale of $8,000. Of that, $6,000 was on credit and $2,000 was received cash at the bank. So that's A-okay, we've got three, but look, 8,000 and 8,000, it all equals, and we can see our assets equal the sum of these liabilities and equity, okay? So that is quite a lot, but I really wanted to just show you how to use this worksheet. Please let me know if you have any questions below. Thank you.